Welcome to the Deep Dive, where we take a stack of the latest insights, research, and news and unpack what truly matters, cutting through the noise to get you well informed. Now, it's August 19th, Tuesday, sitting here at late night around 11 p.m. Eastern Time, or 8 p.m. out on the West Coast, and the financial world has been absolutely buzzing with activity. I'm really curious to understand how all these seemingly disconnected events, from specific company moves to major global policy decisions, actually fit together to paint a cohesive picture for us today.
And welcome to this deep dive. We are committed to providing you with the most accurate, valuable, and timely insights from today's financial world. Today, we'll piece together a compelling financial story, a true tapestry woven from market movements, intricate corporate strategies, and the ever-present pervasive influence of global policy. It's a constant calibration, and we're going to unravel it all for you.
Okay, let's unpack this fascinating narrative starting with the Japanese stock market. We've seen the Nikkei hitting these incredible record highs recently, almost breathtaking in its ascent. But then it took a bit of a tumble today, falling 0.14% to 43,652.32 yen in the morning session, even temporarily dropping over 300 yen. So when a market has been sprinting for so long, is this recent drop just a natural breathing moment for it, like a runner catching their breath? Or is there something more concerning lurking beneath the surface that we should be aware of?
That's a perceptive way to frame it, and you've precisely captured a core market dynamic. What we observed in the Nikkei this morning is indeed a classic instance of profit-taking after a remarkably rapid climb. Imagine a market that's been on an almost uninterrupted ascent since early August, setting consecutive record highs right up until yesterday, August 18th. When any asset or an entire index like the Nikkei Average climbs that quickly and intensely, it frequently triggers what market technicians refer to as overbought conditions.
Overbought conditions. Okay, that sounds intriguing. Could you break that down for us in simple terms? Is it essentially just like too many people buying, pushing the price too high too fast?
You've hit the nail on the head. Yeah, to put it very simply, overbought signifies that the price of an asset has risen too far, too fast. And it's now considered, by certain technical indicators, to be trading at an unsustainably high level in the short term. One of the most common tools traders use to gauge this is the 14-day Relative Strength Index, or RSI. On August 18th, the Nikkei's RSI stood at 71.86%. Now, the conventional threshold for overbought is 70%. So when the RSI crosses above that 70% mark, it's essentially a flashing yellow light, signaling that the asset might be primed for a price correction or a pullback because the buying pressure has been so intense it's simply unsustainable at that pace.
So it's a critical warning sign that the market might need to cool down, but does that mean it's a sign of fundamental weakness, or is it almost, a healthy exhale for the market? I remember hearing about similar technical corrections during other boom periods. Is this kind of market self-correction like a universal thing, or are there times it signals something more troubling?
That's an excellent follow-up question. While it acts as a warning sign, it's generally considered a healthy, natural part of market cycles. After such rapid gains, markets almost invariably need to consolidate or correct, to digest those profits and allow new buyers to maybe enter at more attractive valuations. It's a fundamental aspect of human psychology, playing out in finance, a collective tendency to lock in gains after a significant run. So no, it's not typically a sign of fundamental weakness, not unless it's combined with other deteriorating economic data. For now, it's more akin to the market taking a necessary pit stop. What's particularly fascinating here is that despite this selling pressure from profit-taking, the underlying bullish sentiment in Japan remains quite strong. We're still seeing persistent dip-buying investors eagerly stepping in to buy shares whenever the market pulls back.
Interesting. So people jump in when prices drop a bit.
Exactly. This act of buying actually helped limit further losses in the Nikkei today. It suggests that while there's a short-term adjustment, the longer-term positive outlook hasn't fundamentally changed for many investors.
That makes a lot of sense. Now let's talk about some specific companies that really swing the Nikkei today, because it sounds like SoftBank Group, or SBG, is having a truly wild ride. It announced a massive $2 billion investment in Intel, hit a record high post-stock split, and then almost immediately reversed to a 5% decline, weighing heavily on the Nikkei. It fell for the first time in 10 days. What makes a single company like SoftBank so impactful on the overall index, and why would it reverse so sharply after what seemed like overwhelmingly positive news?
Well, SoftBank Group is an absolute titan in the Japanese market. Its sheer size and substantial weighting in the Nikkei Average mean its movements can disproportionately influence the entire index. Think of it as the anchor tenant in a bustling shopping mall. When they're making a big move, it sends ripples through every other store, affecting foot traffic and sentiment across the entire complex.
Right.
As for the sharp reversal, this is a textbook example of a buy the rumor, sell the news scenario, a pattern that plays out time and again in financial markets.
Ah, I've heard that phrase before. So people anticipate good news, drive up the price, and then once the official announcement is out, they sell. Feels a little counterintuitive.
It can feel that way, absolutely. But it's a common strategy for short-term traders. Investors often pile into a stock when there's speculation or a whisper of positive news, driving up the price in the lead-up to the official confirmation. Once that news is officially confirmed, the speculative air can rapidly leave the trade, and those who bought on the rumor decide it's time to sell the news and lock in their profits.
Got it.
In SoftBank's case, the $2 billion investment in Intel was indeed significant, especially amid broader reports that the Trump administration was considering acquiring a 10% stake in Intel itself, which kind of implicitly validated the sector. But after such a rapid ascent, reaching a record-high post-stock split, the stock became ripe for this kind of profit-taking, causing that sharp reversal and indeed dragging down the broader index.
Okay, that clarifies the SoftBank puzzle. Let's shift our focus to the semiconductor world. This sector feels incredibly complex and, frankly, caught between technology and politics right now. The Philadelphia Semiconductor Index, or SOX, in the U.S. actually managed a slight rise of 0.40%, but over in Tokyo. Well, while some like Kitel saw buying, Advantis continued to decline, falling almost 5%. It was apparently burdened by overall U.S. tech weakness and persistent concerns about U.S. semiconductor tariffs. Fujikura and Discar also saw selling. Could you untangle this complex interplay between U.S. tech performance, these tariff concerns, and their direct impact on Japanese semiconductor companies like Advantis?
You're absolutely right. The semiconductor sector is a unique nexus where technology, economics, and geopolitics don't just intersect, they collide. The interplay is profoundly complex. Firstly, Japanese semiconductor equipment manufacturers like Advantis are deeply intertwined with the global chip industry, particularly the U.S. market. Many Japanese firms are integral parts of the supply chain for major U.S. tech giants. So when the broader NASDAQ Composite Index, which is heavily weighted with tech stocks, shows weakness, or when major U.S. tech companies experience a downturn, it often creates a direct ripple effect on their Japanese suppliers.
Okay.
This isn't just about shared sentiment. It's about shared business relationships and a deeply integrated global supply chain. Advantis, for instance, is a major supplier of semiconductor testing equipment, so its fortunes are inherently tied to the overall health and investment cycles of the global chip industry.
So if U.S. tech isn't doing great, that immediately affects Japanese companies that provide the tools or parts for them, even if the Japanese companies themselves are solid.
Precisely. It's a direct flow. Beyond general tech weakness, the specter of U.S. tariffs is a huge overriding factor. The Trump administration has consistently demonstrated a willingness to use tariffs as a policy tool, and semiconductor tariffs in particular create significant uncertainty. They can directly impact the cost of doing business, alter supply chains, and reduce demand for certain products, weighing heavily on the stock performance of companies like Advantis. This is a very real, tangible concern for investors in this space.
And I also heard something about NVIDIA developing a new AI chip specifically for China, seemingly as a workaround for U.S. export restrictions. How does that fit into this broader semiconductor narrative?
That's a crucial and telling piece of the puzzle, and it really underscores the geopolitical dance we're seeing. There were reports that NVIDIA is developing a new AI chip called B30A specifically designed for the Chinese market. Now here's the key. This chip is based on their latest Blackwell technology, but it's deliberately configured with a single die. That means it has approximately half the computing power of their top-tier U.S. products.
Interesting. Deliberately less powerful.
Exactly. This isn't a technical limitation. It's a direct response to the stringent U.S. government restrictions on advanced semiconductor exports to China, which are in place due to national security concerns. While former President Trump has indicated a willingness to allow downgraded Blackwell shipments to China, regulatory approval for this specific chip remains uncertain. This maneuver highlights how major companies like NVIDIA are navigating an incredibly challenging geopolitical landscape. They're trying to maintain market access in a crucial market like China, while simultaneously complying with increasingly strict U.S. regulations.
Right.
For Japanese suppliers like Advantis, this means that even if global demand for AI chips is strong, The specific market dynamics within China, shaped by these export restrictions, can limit their opportunities, reducing the overall addressable market for the highest-end components. It contributes to the selling pressure we saw today, as the market grapples with a fragmented global supply chain.
That's absolutely fascinating how a single policy decision can ripple through an entire global supply chain, forcing companies to innovate not just for performance, but for compliance. Beyond semiconductors, what other companies made waves today? Were there any surprising winners or losers that stood out?
Absolutely. The market presented a fascinating mix of movements today. In the losing camp, we saw a notable hit to the gaming sector. Industry stalwarts like Konami Group, Nintendo, and Bandai Namco Holdings all experienced declines. The retail giant Fast Retailing also saw selling pressure. And even the beloved Sanrio, the company behind Hello Kitty.
Oh, wow, Sanrio too.
Yeah, briefly dropped over 7% after hitting a record high just yesterday. This widespread weakness in consumer-facing and tech-adjacent sectors suggests a broader market adjustment after strong recent runs, with investors taking profits across the board. On the flip side, we observe considerable strength in the pharmaceutical sector. Daiichi Sankyo and Takeda Pharmaceutical both posted gains, indicating investor confidence in healthcare innovation. Toyota, as a major export-related stock, was boosted by the weaker yen, which makes Japanese exports more competitively priced globally.
Okay.
Other solid performers included Kyocera and Kikkoman.
And I saw something interesting about Pan Pacific International Holdings, the operator of Don Quixote stores. It actually hit a record high today. What was the driving force behind that?
Pan Pacific International Holdings definitely stood out as a clear winner today. They hit a record high after announcing an incredibly ambitious long-term growth plan. They intend to invest over $1.2 trillion, that's roughly $8 billion by June 2035.
Wow, that's huge.
It is. And beyond that decade-long vision, they also projected a substantial 17% year-on-year net profit rise for their June 2026 fiscal year, targeting $105.5 billion. This combination of a clear, aggressive long-term strategy coupled with strong near-term profit projections really resonated with investors, attracting significant growth-focused buying. It's a prime example of a company with transparent strategic direction being handsomely rewarded in the market, standing out against a backdrop of more general profit-taking.
Okay, that's a great overview of the individual company movers and shakers. Now let's shift focus a bit to the broader investment landscape, particularly for everyday investors. I've heard a lot about the new NISA program in Japan. How does something like that influence where regular people are putting their money, and is it really making a tangible difference in stabilizing things, especially when big sovereign funds are so active and often quite volatile?
The new NISA, or Nippon Individual Savings Account, which launched in January 2024, is indeed a monumental development. And yes, it absolutely influences where regular people are putting their money and, by extension, the overall market dynamics. Its primary design encourages consistent long-term investment by offering substantial tax benefits on investment gains. This structural element provides a significant layer of stability to the domestic market. It acts as a powerful counterweight to the often volatile inflows and outflows typical of contrarian trading by larger institutional investors, especially foreign funds,
Right.
who are always looking for short-term opportunities and might move capital very quickly.
So if I'm understanding this correctly, it's essentially building a much more consistent foundational domestic base of support for the market, one that can then absorb some of the shocks from more transient foreign capital.
Precisely. That's a great way to put it. We've seen this directly reflected in the investment trust rankings. While Japanese stock funds as a whole did experience some outflows due to profit-taking today, funds like EMAX's Slim Domestic Stocks, 2PBIX, and Nikkei Average High Dividend Yield Stock Fund actually attracted inflows.
Oh, interesting.
These are often the types of funds that benefit directly from regular, systematic investment plans facilitated by NISA. It smooths out some of the sharp peaks and troughs that would otherwise be caused by rapid institutional movements. Now, to add to the picture of retail investor sentiment, veteran investor Takeshi Uesitoshi, known as Takeso, observed a fascinating polarization among individual investors. On one hand, you have a segment of retail investors who had held long-term positions in stable, large-cap stocks like banks and utilities before the recent rally. These individuals are now sitting on substantial profits.
Nice for them.
Indeed. On the other hand, you have a different group engaging in more short-term, speculative trades in less liquid stocks, like Metaplanet, a Bitcoin-related stock, hoping for quick, aggressive gains. What's common across a broad spectrum of retail investors, however, is an active search for dip buying opportunities. They see pullbacks like today's as a chance to get in at a better price, demonstrating underlying confidence in the market's long-term trajectory.
It sounds like a really fascinating dynamic where some are playing the long game for steady returns and others are trying to ride the immediate waves for quick profits.
Indeed, it's a microcosm of market behavior. And it's not just retail investors adopting these strategies. Analysts like Bruce Kirk from Goldman Sachs are also highlighting undervalued high-liquidity stocks as offering potentially better returns, citing recent underperformers like KDDI and Nikkei HD as examples that might be poised for a rebound. This suggests that even within the current strong market, there's a constant search for overlooked value and opportunities for rotation. Overall, trading on the prime market remains robust, with daily volumes often exceeding $556 trillion. That's roughly 40 billion US dollars changing hands every day.
Wow.
Signaling active participation across all investor types, which is a strong indicator of underlying market health despite the recent adjustments.
So we've dissected the fascinating dynamics within the Japanese market, from overbought conditions to retail investor shifts. But what happens when we zoom out to the global stage? It turns out even the smallest ripples from U.S. interest rates or far-off peace talks can send shockwaves all the way back to the yen. Let's talk about how global currencies become the ultimate barometer of these interconnected forces. The yen, for instance, weakened against the dollar today, hovering around 147.7980 per dollar. This is apparently due to receding expectations for a significant U.S. Fed rate cut in September and strengthening anticipation of higher U.S. interest rates. Why are U.S. interest rates such a big deal for the yen? And how does something as seemingly distant as peace talks in Ukraine affect currencies all the way in Japan? Feels like everything is connected.
It absolutely is connected, and you've identified key intertwined drivers of currency movements. The weakening yen against the dollar primarily stems from what we call interest rate differentials. Imagine investors around the world are constantly seeking the best return on their capital. When interest rates in one country are expected to rise relative to another, that country's currency becomes significantly more attractive.
Okay.
Because investors can earn higher returns on their savings, whether in bonds or bank deposits, denominated in that currency. So if U.S. interest rates are anticipated to be higher than Japan's, investors will sell yen to buy dollars to take advantage of those higher yields in the U.S. The market's FedWatch tool, which provides real-time estimates of future U.S. rate expectations, showed a significant shift. The probability of a 0.50% U.S. rate cut in September dropped to 0, while a 0.25% cut fell to around 80%.
Wow, quite a change.
Exactly. This immediate recalibration of expectations widened the perceived interest rate gap between the U.S. and Japan, making the dollar more appealing and putting pressure on the yen.
So it's a fundamental pull for capital. But are there ever times when safety outweighs yield for the yen, even with these differentials? What other factors could override this primary interest rate dynamic?
That's where the geopolitical piece comes in, and it's a perfect example of other factors influencing currency movements. The yen is traditionally seen as a safe haven currency, much like gold or Swiss francs. In times of global uncertainty, economic turmoil, or geopolitical tension, investors flock to these safe assets, viewing them as stable stores of value.
Right, the safe bet.
Exactly. So when U.S. President Trump announced today that he had begun arranging talks between Russian President Putin and Ukrainian President Zelensky, hopes for a ceasefire or a peace agreement immediately spiked. This risk-on sentiment then diminishes the demand for traditional safe haven assets. Investors become less risk-averse, move out of the yen, and into other currencies or riskier assets like stocks. This illustrates how quickly and directly geopolitical developments, even thousands of miles away, can impact currency valuations, creating a ripple effect across the global financial system. And to reinforce the dollar's strength, S&P Global Ratings also maintained the U.S. credit rating at AA+. This alleviated some lingering fears of a downgrade, providing a crucial sense of security and stability around U.S. assets, which further encouraged dollar purchases against other major currencies. However, it's important to note that the yen's fall was not entirely unchecked. Underlying export-driven domestic demand and some intermittent safe haven yen buying, especially as the Nikkei Average temporarily dipped, did provide some limitations to its decline. It's always a complex push and pull of various, often conflicting forces.
Speaking of the Fed, the entire market is fixated on Jackson Hole. Why does this particular speech by Federal Reserve Chair Powell at the Economic Symposium carry so much weight? Is it truly where we get the first real hints about upcoming policy shifts, or is it more about reinforcing existing expectations?
Jackson Hole is, without exaggeration, one of the most anticipated events on the central banking calendar, and for good reason. It's a historically significant platform for central bankers from around the world to gather, share research, and, crucially, for the Federal Reserve Chair to signal potential policy shifts or provide deeper insights into the Fed's economic outlook. Think of it less as an informal hint-dropping session and more as a meticulously crafted opportunity for the Fed to set the tone and direction for future monetary policy, often with far-reaching market implications.
All right.
Last year, for instance, Powell's speech effectively signaled a clear shift towards lowering policy rates, sending strong signals to the market. This year, the market is keenly focused on whether he will confirm the aggressive expectations for rate cuts, especially given persistent inflation indicators like the recent July CPI and PPI data, and the potential for former President Trump's tariff policies to push up prices further.
So what's the consensus going into this? Is it a given that they're cutting rates, or is there still a lot of debate among the experts? And what does that mean for how the stock market might react?
That's the million-dollar question, and the answer is far from a consensus. The market has been aggressively pricing in rate cuts, with some initial expectations for a September cut soaring to over 90%. However, there's considerable debate among analysts. Some, like Mark Caban of Bank of America, predict Powell will not be as dovish, meaning pro-easing, as the market has priced in. Cabana believes Powell will need to carefully acknowledge persistent inflation risks, even if he highlights rising unemployment risks.
Tricky balance.
Very. Others, such as Andrew Hollenhorst of Citigroup, believe Powell will remain cautious, preferring to wait for the crucial August employment and inflation data before giving any clear signals on a September cut. Julian Emanuel of Evercore ISI takes a more moderate view, expecting a hint at a 0.25% cut in September, but not a more aggressive 0.5% cut, with later cuts remaining strictly data-dependent. This divergence in views creates significant volatility and uncertainty for investors. The implications for the stock market are substantial. The S&P 500's forward-priced earnings ratio, which is a key valuation multiple, is currently around 22.5x.
Which is high, right?
It is considered overvalued compared to its 5-year average of just over 20x. When valuations are stretched like this, major stocks become more prone to selling, particularly ahead of uncertain events like Jackson Hole. An August survey by Bank of America showed a record-high 91% of institutional investors viewing U.S. stocks as overvalued.
Wow, 91%.
Yeah. So, yes, Powell's remarks could very well force a significant correction in stock valuations if he doesn't meet the market's aggressive rate cut expectations, leading to a broader repricing of risk.
With all that uncertainty, it's helpful to get a longer-term perspective. What's WisdomTree's Kevin Flanagan, a renowned bond strategy expert, expecting from the Fed in the coming years?
Kevin Flanagan, who leads bond strategy at WisdomTree, offers a detailed and nuanced forecast that cuts through some of the short-term noise. He anticipates the U.S. Federal Reserve will implement 2 to 3 rate cuts in 2025.
Okay, 2 to 3.
Possibly even consecutive cuts if the job market continues to show signs of slowing down. He then forecasts 2 additional cuts in 2026. What's critical to his perspective is his emphasis on employment indicators being more critical than price trends for the Fed's ultimate decisions. He argues that a resilient labor market prevents a severe recession even amidst persistent inflation, providing the Fed with more flexibility.
Interesting take.
He also believes that the impact of former President Trump's potential tariffs on prices will be slow and not an excessive concern for the Fed in the immediate term. A particularly insightful point he raises is that even a Trump-nominated Fed chair would be constrained by the FOMC's consensus-driven decision-making process. This means that extreme, dovish, or aggressively pro-easing shifts are highly unlikely, regardless of who is at the helm. This analysis provides a more balanced and somewhat reassuring long-term perspective on the Fed's independence and its likely data-dependent path forward.
Moving on to corporate strategies, I saw something intriguing about West Nippon Expressway. They're conducting a demand survey for a 3-tranche social bond issuance, totaling about $60 billion. Social bonds. That sounds like money for a good cause, almost philanthropic. How are these different from regular bonds, and why would an expressway company be issuing them?
That's an excellent question, and it truly highlights a growing and very important trend in corporate finance. Social bonds are a specific type of thematic bond, quite similar to green bonds, but with a distinct focus. The key difference is that the proceeds from social bonds are exclusively used to finance projects with demonstrable positive social outcomes. Unlike regular corporate bonds, which fund general business purposes, social bonds come with a clear commitment to address specific social issues. Things like affordable basic infrastructure, enhancing access to essential services for communities, or socioeconomic empowerment. They are designed to attract capital that seeks both financial return and social impact.
So it's not just about raising money, but raising money for something very specific and beneficial with a clear social mission attached.
Exactly. For an expressway company like West Nippon Expressway, issuing social bonds means they are earmarking these $60 billion in funds for projects that might include vital safety improvements, enhancing accessibility for disabled individuals or underserved communities along their routes, or even initiatives that contribute to local community well-being or environmental preservation linked to their infrastructure. This attracts a specific segment of investors focused on ESG, environmental, social, and governance factors, effectively diversifying their funding sources beyond traditional investors who might only look at financial returns.
I see.
The fact that these bonds comply with the stringent International Capital Market Association, or ICMA, principles and have received a robust second opinion from Rating and Investment Information, R&I, adds a crucial layer of credibility and transparency to their stated social impact, making them highly attractive to socially conscious capital.
That's a smart way to align finance with broader societal goals. Now, staying on corporate strategy, Nippon Express Holdings, or NXHD, is making a really big move. They're selling off over $50 billion in low-profit domestic warehouses by fiscal year 2028. What does it mean when they say they're selling low ROIC assets, and how does that help their overall business and value? It sounds like they're shedding parts of their core business.
This is indeed a significant strategic maneuver, but it's a classic example of sophisticated asset management aimed squarely at boosting corporate value. ROIC stands for Return on Invested Capital. In simple terms, it's a critical metric that measures how efficiently a company uses its invested capital, meaning its assets, like these warehouses, to generate profit.
Okay, efficiency measure.
Right. When NXHD talks about selling low ROBC assets, they're identifying warehouses that are not generating sufficient returns relative to the capital tied up in them. Specifically, they're targeting assets with an ROIC below 5%. Think of it like a seasoned chef reviewing their pantry. If some ingredients are very expensive but only contribute a small amount to the flavor or profitability of the final dish, it makes perfect sense to remove them and replace them with more cost-effective or higher-yield alternatives.
So they're not just selling off assets randomly, they're clearing out the less efficient parts of their portfolio to make room for better opportunities.
Precisely. By divesting these underperforming domestic warehouses, NXHD can then strategically reallocate that capital to higher growth, more profitable areas. Their stated plan is to fund overseas mergers and acquisitions M&A, particularly in rapidly expanding markets like the U.S. and India, targeting projects that are expected to yield a much higher ROIC, around 10%, including the synergies they anticipate.
Reinvesting for higher returns.
It's exactly. This dramatically improves their overall capital efficiency and profitability. This strategic shift is also a direct response to their relatively low price-to-book ratio, or PBR, which currently stands at 0.95x, indicating that the market values them below their book value. They're also aiming for a return on equity, or ROE, above 10% by fiscal year 2028. These bold actions, combined with a record share buyback of up to $50 billion, representing 11.53% of their shares, are strong signals of their unwavering commitment to optimizing their capital structure and significantly enhancing shareholder returns, even within a challenging and highly competitive international logistics environment. It's about becoming leaner, more agile, and strategically positioning themselves to chase higher, more efficient returns globally.
That makes a lot of sense. Reallocating capital to where it can generate more value, even if it means selling off what used to be considered core assets. Now, let's talk about something incredibly impactful, pharma breakthroughs. Daiichi Sankyo's stock rose for 3 consecutive days after its cancer drug candidate, ifinatamab deruxtecan, received breakthrough therapy designation from the U.S. FDA. That designation sounds incredibly important. Does this mean the drug is a sure thing for approval? And how quickly can something like this really affect a company's financial outlook?
The breakthrough therapy designation from the U.S. FDA is, as you said, incredibly significant. But it's important to clarify that it doesn't mean the drug is a sure thing in terms of immediate market approval or commercial success. What it does mean is that the FDA has made a preliminary determination based on early clinical evidence, that this drug, ifinatamab deruxtecan, has demonstrated the potential for substantial improvement over existing therapies for a serious or life-threatening condition. In this specific case, it's for advanced small cell lung cancer, which is notoriously aggressive, characterized by rapid progression and tragically low survival rates.
So it's more of a very high-speed fast track then, rather than an automatic green light.
Exactly. It's a very high-priority fast track that dramatically expedites the drug's development and review process. This designation provides Daiichi Sankyo with intensive guidance from the FDA, including organizational commitment from senior FDA managers. It also makes the drug eligible for rolling review.
Rolling review.
Yeah, where portions of the application can be submitted and reviewed as they are completed, rather than waiting for the entire package. This significantly de-risks the drug's path to market by accelerating the regulatory timeline and substantially increasing the likelihood of eventual approval, assuming the ongoing clinical trials continue to show positive results.
Okay, so still needs final approval, but a huge boost.
A huge boost, yes. This heightened confidence immediately and positively impacts a company's financial outlook, even if the drug isn't on shelves yet. While Daiichi Sankyo hasn't factored the drug's potential revenue into its fiscal year 2026 forecasts, they do expect significant milestone payments from their co-developer, Merck. Analysts, such as Hidemaru Yamaguchi of Citigroup Securities, see substantial upside potential because the market hasn't yet fully priced in the drug's long-term prospects or its potential blockbuster status. The clinical trial results will be presented at the World Lung Cancer Conference in September, which will be another key moment that could fuel even greater investor optimism and further re-rate the stock.
That's a huge deal for Daiichi Sankyo, and hopefully for patients too. All right, let's broaden our view again and look at some other shifts happening in consumer and tech sectors. Suntory BF, for example, saw its stock fall for 5 days straight. What happened there? It's such a well-known brand.
Suntory BF's prolonged decline was primarily triggered by a significant downgrade from Daiwa Securities. They cited considerable challenges in ensuring sustainable profit growth. Despite the company's robust efforts in branding and promotions across Japan, Vietnam, and Thailand, analyst Shun Igarashi noted that the intensely competitive domestic beverage market lacks strong volume growth, making it tough to expand.
Tough competition.
Exactly. Furthermore, economic difficulties and a challenging consumer environment in key overseas markets like Vietnam and Thailand are posing tough conditions. So it's a story of even a well-established, beloved company struggling against the twin headwinds of market saturation and broader economic challenges in its key growth regions.
Okay, that makes sense. But then, on the flip side, Asuka Pharmaceutical Holdings surged dramatically by almost 14%. What was behind that sudden spike?
Asuka Pharmaceutical HT surged because of a bold move by the U.S. investment fund Dalton Investments. Dalton expressed its clear intent to increase its stake in Asuka to approximately 30%, and critically, proposed a management buyout, or MBO, to take the company private.
Take it private, wow.
Yes. This announcement immediately triggered intense speculative buying. The market reacted with the expectation of a tightening of stock supply should Dalton succeed, and the anticipation of significant corporate changes under Dalton's activist influence. Asuka itself has even voiced concerns about Dalton's motives, reportedly considering countermeasures like issuing free stock warrants to other shareholders to dilute Dalton's stake. It's a classic, high-stakes activist shareholder play pushing aggressively for corporate restructuring.
Fascinating. And Furuno Electric, another company, hit an all-time high today. What's driving that kind of performance?
Furuno Electric, a major player in marine electronics, saw its stock surge to an all-time high after Nomura Securities initiated coverage with a buy rating and a target price significantly above its current trading level. Nomura highlighted Furuno's much-improved earnings structure, attributing it to increased shipbuilding completions globally and a growing proportion of higher-margin maintenance services.
Maintenance paying off.
Precisely. They anticipate peak demand around 2030, driven by the need for fleet renewal and the growing global demand for eco-friendly vessels, which require advanced electronics. Despite its recent impressive run, analysts view it as still undervalued, signaling strong long-term growth potential in the specialized marine electronics sector.
And Rakuten Group, always innovating, is apparently getting into satellite communication by 2026. How big of a deal is that for them and for Japan?
That's potentially a transformative development for Rakuten and a strategic play for Japan's connectivity. Reports indicate Rakuten's planned entry into Japan's satellite communication market by 2026, collaborating with tech giants like Amazon.com and satellite communication specialists AST SpaceMobile. The Ministry of Internal Affairs is already actively preparing regulations for direct satellite-to-smartphone communication, targeting implementation by summer 2026.
Satellite to phone directly.
Yes. This initiative opens up entirely new service avenues for Rakuten Mobile, enabling seamless communication in remote areas that currently lack traditional base stations and offering crucial disaster resilience, which is highly valued in an earthquake-prone country like Japan. It's a bold leap into a cutting-edge sector that could redefine connectivity.
And Best Buy is expanding its marketplace business in the U.S. That's not just electronics anymore, right?
Exactly. Best Buy stock rose 5.3% on the news of its U.S. marketplace business launch. This is a significant strategic shift for them, moving beyond their traditional electronics focus. It allows external vendors to sell a much broader range of products, effectively doubling the available items to include categories like auto parts, furniture, and even toys.
Toys at Best Buy.
Right. What makes this particularly promising is that their Canadian marketplace, which launched back in 2016, already accounts for an impressive one-third of their online shipments. Analysts are expecting similar high-margin commission income opportunities in the U.S. Plus, the convenience of accepting returns for these marketplace items in their physical stores is a huge consumer draw, leveraging their existing retail footprint.
Finally, we saw a rise in China consumer stocks today. What's behind that?
The rise in Hong Kong consumer-related stocks, like sportswear giant Li-Ning, popular hot pot chain Haidilao, and luxury car dealer Zhongsheng Group, followed Chinese Premier Li Chang's recent emphasis on strengthening domestic demand to offset external uncertainties. He also specifically mentioned deregulation. This policy signal is particularly relevant after weaker-than-expected July retail sales data, which fueled expectations for more proactive government support measures aimed at boosting internal consumption within China.
Government push for spending.
Exactly. It's a direct response to macroeconomic concerns, with a clear policy signal for revitalizing internal economic activity. This isn't just about a short-term stock bump. It signifies China's strategic pivot towards internal consumption as a primary growth engine, a major shift that could reshape global supply chains and create new long-term opportunities for companies that can tap into this domestic demand.
Returning to the semiconductor industry, which we touched on earlier, it genuinely feels like it's caught between technological innovation and very direct political intervention. There are reports that the Trump administration is considering acquiring shares in semiconductor companies that receive CHIPS Act subsidies, including Micron Technology, Samsung Electronics, and TSMC, beyond the already reported plans for Intel. What does it actually mean for the government to buy shares in these private companies? Is that common for the U.S.?
This is truly a significant and, frankly, highly unusual development. For the U.S. government to directly acquire shares in private, publicly traded companies is not common at all, especially not in strategic industries like this. It reflects an incredibly proactive and interventionist industrial policy designed to secure domestic supply chains and exert direct influence over strategic sectors like semiconductors, which are now deemed absolutely critical for national security and economic competitiveness.
So it's not just about giving them money through subsidies, but actually becoming part owners and having a direct stake.
Precisely. U.S. Commerce Secretary Ray Tonick commented on this, suggesting it's a way for the administration to gain leverage and ensure these companies align with broader national objectives, such as building robust domestic manufacturing capacity, without necessarily interfering with their day-to-day management.
Leverage without managing.
Right. It's a powerful tool to shape an industry. The crucial point here is that most of the CHEPS Act subsidies, billions of dollars, have not yet been dispersed. This gives the administration immense leverage in these negotiations. Former President Trump is reportedly favorable towards this plan, signaling a continued focus on using government policy and even direct ownership to shape strategic industries. This creates a new and complex layer for these global corporations, who now must consider not just market forces and technological imperatives, but also potential government ownership and influence in their long-term strategic planning. It's a fundamental shift in the relationship between state and industry in the U.S.
Wow, that's a big shift in how the government interacts with private industry, and it has profound implications. Let's broaden our view one last time to the overall economic picture, particularly for the U.S. We've seen a mixed bag of July data. Housing starts rose, retail sales grew, but industrial production dipped, and the producer price index increased. What's the big picture story these different economic signals are telling us about the U.S. economy right now? Is it fundamentally growing, or are we seeing signs of a slowdown?
The data certainly paints a decidedly mixed picture. It reveals an economy that is simultaneously demonstrating resilience in some key areas while showing signs of deceleration in others, all while grappling with persistent inflationary pressures. The unexpected rise in July housing starts, up a robust 5.2% month-on-month, and the 0.5% growth in retail sales indicate a surprisingly resilient consumer and a still active housing market. These sectors are traditionally key pillars of economic strength, suggesting underlying demand.
So on one hand, consumers are still spending and building, which usually points to healthy growth, right?
In isolation, Yes, those are certainly positive indicators. However, the accompanying dip in industrial production by 0.1% suggests a tangible softening in the manufacturing and broader industrial sectors. This could point to businesses pulling back slightly on production amid evolving demand patterns or higher input costs. Crucially, the 0.9% increase in the Producer Price Index, or PPI, reinforces existing concerns about inflation. It indicates that producers are facing higher costs for goods and services, which could eventually filter down to consumer prices.
Inflation's still sticky then.
Yes. While initial jobless claims slightly declined, suggesting a still tight labor market, the drop in consumer sentiment points to households feeling less optimistic about their economic future. So the big picture is an economy that's not uniformly strong or uniformly weak. Instead, it's navigating a complex path, resilient in consumption and housing, slowing in industrial activity, and still battling those inflationary headwinds. This creates a particularly challenging and uncertain environment for the Federal Reserve as it contemplates its next monetary policy moves.
That makes the Fed's job sound incredibly complicated, trying to balance all those factors. How are global markets reacting to this mixed economic picture, and what's the immediate outlook? Let's start with U.S. stocks.
U.S. stocks reflected this very complexity. The Dow Jones Industrial Average rebounded slightly, up 0.02%, supported by gains in Home Depot, which managed to maintain its profit outlook despite missing sales expectations, and also by a general rotation into defensive stocks. The Dow even briefly surpassed its all-time high, showing that some sectors are finding strength and stability.
Dow holding up, but tech.
Exactly. The tech sector, which has been a major driver of recent market gains, saw significant declines. NVIDIA, for instance, was notably down 3.5%, along with other giants like Microsoft, Advanced Micro Devices, AMD, and Palantir Technologies.
Why did tech stocks take such a hit when the Dow was up? What separated their performance today?
There were several contributing factors to the tech sector sell-off. Firstly, there was clear profit-taking after their recent, often parabolic gains. Many investors decided to lock in those impressive returns.
Makes sense.
Secondly, the aforementioned concerns about government intervention in the semiconductor sector, such as the potential for the U.S. government to acquire a stake in Intel, weighed heavily. This kind of direct government involvement introduces a new layer of uncertainty and potential constraints for investors. And thirdly, comments from OpenAI CEO Sam Altman, who suggested that artificial intelligence is entering a bubble period, likely spooked some investors, leading to a broader pullback in AI-related and high-growth tech stocks.
The bubble word. Never good.
No, it often causes jitters. As a result, the Nasdaq Composite Index, which is heavily weighted towards tech, fell a notable 1.45%.
What about German stocks? Did they follow suit, or did they diverge from the U.S. market's pattern?
The German DAX index actually rebounded quite strongly, up 0.44% to a one-month high, illustrating a divergence from the U.S. tech-led weakness. This rebound primarily reflected improved investor sentiment, largely due to eased Ukraine tensions following former President Trump's discussions with Ukrainian President Zelensky and European leaders.
Geopolitics again.
Absolutely. When geopolitical risks de-escalate, market confidence can quickly shift, and investors often rotate out of defensive positions and into more cyclically sensitive sectors that benefit from economic stability. This led to gains in key sectors like automotive, chemical, and financial stocks, while defense firm Rheinmetall, which often benefits from geopolitical tensions, saw declines. It's a clear example of how reduced global uncertainty can directly boost broader European market confidence and shift investor focus.
And commodities like crude oil and gold also saw declines. Is that directly related to the geopolitical calm as well?
Absolutely. The declines in commodities are directly linked to the easing geopolitical tensions. Crude oil futures, specifically West Texas Intermediate, WTI, fell 1.7% to $62.35 per barrel, and gold declined for the fourth consecutive day, down 0.6%. The ongoing Russia-Ukraine ceasefire talks significantly eased crude oil supply concerns as the risk of disruptions diminished. Similarly, the reduced geopolitical risk also diminished gold's appeal as a traditional safe haven asset. Investors feel less need to hold assets that typically perform well during times of crisis and instead move into higher yielding or growth assets.
I've heard of something called the dollar smile theory in relation to oil prices and the dollar. Does that fit into this current scenario?
It does, quite relevantly. Analysts from major financial institutions like JP Morgan and Societe Generale are indeed linking lower energy prices to a potential weaker dollar scenario. The dollar smile theory is a concept that suggests the dollar can strengthen when the U.S. economy is performing exceptionally well, the smile on the far right, or exceptionally poorly when it acts as a safe haven, the smile on the far left. In the middle, when the U.S. economy is growing moderately but not exceptionally, the dollar tends to be weaker.
The middle of the smile.
Exactly. In this current context, if lower energy prices help to ease U.S. inflation, it could give the Federal Reserve more room to implement those rate cuts the market is hoping for. This scenario of easier monetary policy in the U.S. typically leads to a weaker dollar, which is the middle part of that smile. And this can be a huge tailwind for import-dependent economies like Japan and the Eurozone, as it makes their imports, especially energy, much cheaper. So yes, the stability of oil prices is crucial for this dollar bear scenario to play out, influencing global trade balances and investment flows.
And what about bonds? Did the flight to safety from tech stocks affect bond yields?
Yes, quite directly, but with regional variations. In the U.S., long-term bonds rebounded, causing the benchmark 10-year yield to fall to 4.30%. The significant decline in tech stocks prompted a classic flight to safety into U.S. Treasuries, which are considered among the safest assets globally. This increased demand pushed bond prices up and yields down.
Okay, typical safety move.
Right. In Japan, however, the situation was a bit different. Japanese long-term interest rates actually rose further, with the 10-year yield reaching 1.595%, its highest since late July. Despite the general global dynamic, the weak demand seen in the 20-year Japanese bond auction indicated lingering investor hesitancy and persistent concerns about supply-demand conditions, particularly for super long-term bonds in Japan. This underlying supply concern kept upward pressure on yields there, creating a divergence from U.S. bond movements.
What a deep dive today. It's clearer than ever that the global financial landscape is incredibly dynamic, with so many interconnected forces at play, from nuanced corporate strategies and central bank policies to the profound ripple effects of global politics. It truly is a complex, ever-evolving picture.
Indeed. We've seen markets adjusting after periods of rapid gains, central banks navigating a mixed bag of complex economic data points, and corporations adapting their strategies in response to both economic and geopolitical shifts. The enduring key takeaway, if we distill it all, is the persistent, fundamental search for value and efficiency across all sectors. Whether through strategic asset sales, groundbreaking innovative drug development, or bold new market entries, it's a constant recalibration of risk and opportunity in a truly globalized financial system. As we look ahead, that persistent balancing act between fostering economic growth, managing persistent inflation, and maintaining geopolitical stability will continue to define the investment landscape. How will you factor these ongoing, profound shifts into your understanding of the world economy? We are committed to providing you with the most accurate, valuable, and timely information and analysis to help you navigate it all. Thank you for joining us on this deep dive into today's financial headlines. Until next time.
Stay informed, stay curious, and we'll unpack more for you soon.